This budget isn't a headline event anymore. It's a pricing event, and the market is already moving before the speech even starts. You can feel it in the way liquidity thins, in the way spreads get jumpy, in the way people who swear they don't trade budget suddenly start talking about hedges, not opinions. And the conflict is simple. The official story will try to reduce everything to sentiment, while the market is quietly being driven by mechanics, forced flows, currency stress, and the one detail most people never look at until it's too late. Because later in this video, I'm going to give you a clean checklist for what matters in the next 1 to 2 weeks, the levels that actually change behavior, and the specific signals that confirm the move versus the signals that tell you it's a trap. Let's start with what's obvious, because it's not the most important part, but it sets the stage. Gold has been acting like a market that's no longer asking for permission. Silver has been acting like a market that's tired of being ignored. And equities, especially the parts of the equity market that everyone crowded into because India growth story, have been wobbling in a way that doesn't show up if you only stare at the index level and ignore what's underneath. That mix matters, because budget week isn't just about where price is. It's about where positioning is, where risk is hiding, and where the next forced decision comes from, and that's where the real pressure starts. Now here's where mainstream coverage will lose you. You'll hear a lot of gold rises because fear and stocks fall because uncertainty. That's the lazy explanation. Sometimes it's even directionally correct, but it's not actionable. And it breaks the moment you look at currency translation and term structure in the same frame, because India is not trading gold in a vacuum. India is trading gold through the lens of the rupee, through the lens of import flows, through the lens of duty and premiums, and through the lens of what budget policy implies for rates and liquidity. That's the mechanism, that's the math. And the next detail is what flips the whole setup. If the rupee is under pressure, your local gold chart is not the same chart as the world's gold chart. Say that again, slower, because it saves people money. Even if international gold is flat, a weaker currency can push domestic gold higher. And when budget week hits, you often get a double impulse. Policy expectations push your bond market and your currency, and that translation pushes your local commodity prices. That's not conspiracy, that's just arithmetic and incentives. And once the crowd starts noticing that arithmetic, behavior changes fast. So what is Budget 2026 actually doing to gold, silver, and equities? 3 channels. 1, the physical channel, duties, import costs, refining logistics, premiums, and how quickly real metal can move. 2, the macro channel, deficit expectations, bond supply, growth assumptions, inflation expectations, and the rate path that falls out of that. 3, the liquidities and positioning channel, who is overexposed, where options dealers are pinned, where margin pressure forces selling or forces buying, and how thin liquidity turns normal moves into gaps. Most people are only watching channel 3 on budget day because that's where the fireworks are. But channel 1 and 2 determine whether those fireworks are a one-night show or the start of a longer trend, and that's not the part that gets talked about. Let's talk calendar first, because why now is never optional. Budget day isn't happening in a clean, neutral market. It's happening with month-end pressures still in the air, with positioning already tilted, and with a market that has learned the hard way that policy surprises don't arrive politely during deep liquidity. They arrive when liquidity is thin. Budget week also sits in a time window where people rebalance and de-risk. Funds that ran up exposure into the new year start looking at volatility and asking a very boring question. How much pain am I willing to wear if I am wrong? Dealers look at their books and ask an even simpler question. Where do I get hurt if spot jumps and vols spike? And then the whole game becomes less about what you think and more about what you're forced to do. Because if this one level breaks, the math changes. Now I want to give you the underappreciated detail, the hidden detail, that reframes the entire story. The hidden detail is not the headline number in the budget. It's not even the direction of the market on the day. The hidden detail is the tension between paper pricing and physical urgency. And you see it first in spreads and availability, not in the headline price. When the market is healthy and well supplied, the curve behaves calmly. When the market is tight, when near-term demand is impatient, when financing costs bite, when deliverable supply is less flexible than people assumed, the curve starts talking. And the curve often speaks before the crowd does. But that's not the part that matters to most viewers, so they miss it until the move is already halfway done. Here's how to think about it without getting lost in jargon. Gold and silver trade in 2 worlds at the same time. There's the financial world, futures, options, leverage positioning, hedge books. And there's the physical world, refining lead times, shipping, vault inventory, fabrication demand, and local premiums. In normal times, those worlds mostly stay aligned. In stressed times, they argue. And the argument shows up as basis, as backwardation tendencies, as odd behavior in near-dated spreads, as premiums that don't match the screen price, and as sudden changes in how easy it is to source metal without paying up. That is the spread is telling the truth moment. And the next detail is where this connects directly to Budget 2026. A budget can change the physical equation faster than people think. If duties or compliance rules shift, if incentives around domestic refining or scrap flows change, if the cost of importing changes even slightly, the marginal metal source changes. And in a market that's already sensitive, where demand can surge into festivals, weddings, savings behavior, or hedging episodes, small policy moves can create outsized behavior. Not because the policy is huge, because the supply chain is not instantly elastic. And that's where the real stress shows up. Now layer in macro. The fastest way budget hits gold isn't fear. It's real yields and currency. Budgets imply fiscal stance. Fiscal stance implies bond supply and expected issuance. Bond supply and expected issuance influence yields. Yields influence real yields once you net out inflation expectations. Real yields influence gold math, because gold is priced against the opportunity cost of holding something that doesn't yield. If the market decides budget is inflationary, or that deficit discipline is looser than expected, or that bond supply will pressure yields in a messy way, you can get a very specific pattern. Currency pressure plus inflation anxiety plus hedging demand. That's not mystical. That's the macro plumbing. And once that plumbing starts flowing, it drags other assets with it. But that's not the part that matters to most people until they see it on the screen. Now, equities. Equities react to budget in two ways at once. The obvious way is narrative. Capex up, infra up, consumption up, taxes up or down. Certain sectors win, certain sectors lose. The less obvious way is liquidity and after-tax payoff. If policy changes the effective return profile, capital gains rules, transaction costs, compliance friction, or even just the implied path of rates, equities can rally on good news and still get sold because the discount rate and risk premium changed. And when that happens in a market that's already crowded, you don't get a gentle rotation. You get a shove. You get forced selling in what was popular and forced buying in what was underowned. And you can watch it in breadth before you feel it in your portfolio. And that's where the real pressure starts. So what do we watch? Not opinions, instruments, signals that can't lie. I'm going to stack proof for you, not because one data point wins, but because markets only pay you when multiple layers point the same direction. First proof point, currency. Watch USD-INR like it's a heartbeat monitor, not a trivia chart. If the rupee stabilizes or strengthens sharply after budget, that changes the local impulse for gold. If the rupee weakens, local gold can keep grinding higher even if global gold pauses, and that keeps the psychology bit alive. That matters this week because currency moves are fast and they front-run the narrative. Second proof point, the curve and near-dated behavior. You don't need to be an expert in term structure to notice when the front of the curve gets jumpy. If near-dated spreads tighten aggressively, if the market starts paying up for immediacy, that suggests urgency, either physical pull or hedging demand or both. If the curve relaxes and spreads soften while price tries to go higher, that's a warning sign that the move might be more paper than physical. And that's not the part that makes headlines, but it is the part that tells you what kind of move you're in. Third proof point, local premiums and availability. You'll see it in the real world before you see it in the daily candle. If people are suddenly complaining about delivery delays, if retail premiums don't come down when spot dips, if the discounts vanish and dealers get picky, that is physical friction. That friction doesn't guarantee higher prices tomorrow, but it changes the balance of power between dip buyers and dip sellers. And that's where the real pressure starts. Fourth proof point, equity breadth, advanced decline, sector rotation, mid and small caps versus large caps. If the index holds but breadth deteriorates, that means the market is being propped by a few heavyweights while risk is being drained from the wider tape. That's classic pre-event behavior when managers want to look stable but reduce exposure under the surface. If breadth improves after budget while volatility falls, that's a sign the market accepted the policy mix and risk appetite is back. If breadth stays weak and volatility bids, that's a sign the market is not satisfied, even if the anchors look okay. Fifth proof point, implied volatility and skew. Options are where fear gets priced honestly. If put skew steepens, meaning downside protection gets more expensive relative to calls, funds are paying up to defend. If volatility gets crushed while price holds, that can be supportive for equities and can also cap the urgency bid in metals, depending on what currency does. But if vol rises with price, especially in silver, that's the signature of convexity and reflexivity, where moves beget more moves because hedges and dealers get forced into flows. And that's the next detail that flips the whole setup. Let's unpack that reflexivity piece because it's one of the cleanest mechanism explainers you can carry around. When a lot of options exist around certain strikes, common during event weeks, dealers who sold options hedge dynamically. If price moves toward big strikes, dealer hedging can amplify the move. In a continuation squeeze scenario, price rises, dealers have to buy to stay hedged, the buying pushes price further, which forces more hedging. That's gamma. That's not a story. That's a feedback loop. And silver, because it's smaller and more volatile, can express that loop more violently than gold. That's why silver can feel like it goes from asleep to feral in a week. And that's where the real pressure starts. Now bring it back to budget 2026 specifically. There are a few policy levers everyone will talk about, and a few that matter more than the crowd realizes. The duty and import cost lever matters for metals because India is a massive participant in physical demand. If duties get adjusted, the immediate question isn't, is that bullish or bearish? The immediate question is, what happens to the marginal buyer's behavior? Lower friction can unlock demand and reduce incentive for gray routes. Higher friction can suppress official flows, but sometimes increases local premiums and scarcity psychology. Either way, the market can react in ways that surprise people who only look at spot price. Because the physical channel reacts with delays, bottlenecks, and premium adjustments, that's the part that matters. The fiscal stance lever matters because it influences the bond market. If budget signals strong capex with credible funding and contained inflation risk, equities can breathe and real yields can behave. If budget signals spending without confidence in the path, bond yields can react, currency can react, and then gold's math changes. And when gold's math changes, it doesn't ask equities for permission. The tax and market structure lever matters because it impacts flows. Even the anticipation of capital gains changes can shift positioning ahead of the event. If the market expects any tightening, people front-run by trimming. If the market expects relief, people front-run by holding risk, and that makes any disappointment sharper. This is why budget day moves can feel irrational. They're not irrational. They're the release of positioning. So where does that leave you right now, today, this week? It leaves you with a clean two-scenario lens, because finance credibility comes from admitting uncertainty while still having a plan. Scenario 1 is the controlled pullback and retest. In this scenario, metals cool off after the pre-budget run. Gold consolidates, silver breathes, and the market tries to shake out late chasers. Equities might dip, then stabilize, then rotate. The key is what happens on the retest. Does the dip get bought with calm spreads and stable currency, or does the dip get bought with panic and widening skews? In a healthy trend, pullbacks are orderly, and the market doesn't need to beg for buyers. In a fragile move, the pullback feels like a cliff, spreads loosen, and the bid disappears. And that's where the real pressure starts. Scenario 2 is the continuation squeeze and gap risk. In this scenario, budget triggers a currency impulse or a rates impulse, metals catch an urgency bid, and silver expresses it with violence. Equities either rally on a perceived growth positive stance or sell off on rate currency stress, but the defining feature is speed. You don't get neat entries, you get gaps, you get slippage. You get people making decisions based on emotion and headlines because price moved too fast for analysis. This is where gamma and short covering show up. Shorts get trapped, margin calls hit, forced buying accelerates. And the next detail is what separates profit from pain, knowing what would invalidate the move, not just what would confirm it. So let's get practical. What are the levels that matter? Not magic numbers, behavioral levels, levels that change what participants are forced to do. And for gold, the key level is not a round number. The key level is the prior breakout zone that, if lost and not reclaimed quickly, tells you the move was mostly positioning and not accumulation. If gold breaks out and then fails back below the breakout zone with rising volatility and strengthening currency, that's a warning. If gold pulls back into the breakout zone and holds it while the rupee stays pressured or while global real yields stay supportive, that's confirmation. The level is the area where dip buyers must defend or the thesis weakens. For silver, the key level is the most recent impulse base, the zone where the last wave of buying started. Silver is mean. It overshoots. It shakes you out. If silver loses the impulse base and can't reclaim it, you're likely in a volatility flush, not a healthy trend. If silver retests the base, holds, and then starts printing higher lows while vol stays bid, that's not calm, but it can be a sign the squeeze dynamic is still alive. And that's where the real pressure starts. For equities, stop staring at the index number alone. Watch the index relative to breadth and sector rotation. The behavioral level in equities is the zone where the market either rotates into defensives and quality or rotates back into cyclicals and growth. If budget outcome pushes yields higher and the currency weaker, you often see financials and rate-sensitive sectors behave differently, while exporters might behave differently. If the tape says risk on, but breadth says risk off, respect breadth, because breadth is the lie detector, and that's not the part that matters to the talking heads. Now, I am going to give you a near-term roadmap for the next week or two that doesn't depend on guessing the budget headline. Step 1, watch the immediate post-budget currency reaction. Not the first 5 minutes. Those can be noisy. Watch the first full session and the next session. Does USD INR calm down, or does it keep pushing? If it keeps pushing, local metals keep their tailwind. If it calms down hard, Metals may need global support to keep rising. That's simple, that's powerful, and that's where the real pressure starts. Step 2, watch the metal spreads and the feel of the market. Are near-dated spreads calm or stressed? Are dips bought quickly or do they bleed? Are premiums easing or staying sticky? This tells you whether the move is being supported by real demand and hedging urgency or just paper froth. Step 3, watch equities, breadth, and volatility. If volatility falls and breadth improves, that's supportive for a post-event equity bid. If volatility rises and breadth stays weak, the market is telling you risk is being reduced, not reallocated. In that second case, gold and silver often benefit from the insurance bid, especially if currency is unstable. Step 4, watch positioning tells. You'll see it in how people talk. If every dip in metals becomes manipulation, that's usually late cycle emotion. If dips are met with quiet buying and spreads don't freak out, that's healthier. If equities are sold on good headlines, that's a positioning unwind. If equities rally on bad headlines, that's covering. Price action is psychology made visible. And that's the next detail that flips the whole setup. Now, I need to drop the viewer psychology shield right here because budget week is when emotions get engineered. Volatility is a weapon. It's not personal, it's structural. Big moves aren't just markets being crazy. Big moves force behavior. They force stops. They force margin. They force hedges. And those forced actions become liquidity for someone else. The most common trap is getting shaken out on noise and then chasing the same asset higher because you're angry. That's how people lose twice. So here's the rule. Separate trend signal from noise. Trend signal looks like higher lows that hold key zones, stable or supportive macro inputs, and confirmation from at least a few of the proof points we listed. Currency, spreads, premiums, breadth, skew. Noise looks like a 1-hour spike, a headline-driven whipsaw, a social media narrative that changes 3 times a day. You don't need to predict every candle. You need to avoid being emotionally hijacked, because if the thesis is correct, price can still whip around violently. That's not a contradiction. That's the market's personality. And that's where the real pressure starts. So what would confirm the bullish metals thesis into and after budget? A combination of these: rupee pressure or instability that doesn't reverse cleanly, gold holding its breakout zones on pullbacks, silver holding its impulse base, even if it's chaotic near-dated spreads and physical signals not relaxing too much, and equity risk staying selective or fragile, so the insurance bid persists. If those line up, the path of least resistance can remain up, with silver doing what silver does, overreacting to everything. What would weaken or invalidate the metals thesis? A sharp and sustained rupee stabilization alongside easing inflation pressure, a relaxation of metal spreads and premiums that signals physical urgency is fading, and a risk on equity tape with improving breadth and falling skew that suggests fear is being priced out. Also, if yields move in a way that raises real yields meaningfully and the market starts rewarding cash and carry again, that can cap gold's upside in the short term. None of that means gold is over forever. It means the next 2 weeks might be consolidation, not continuation, and that distinction saves you from making a high conviction bet at the worst moment. On equities, what confirms a constructive post-budget setup? Improved breadth, leadership in sectors that benefit from the policy mix, falling implied volatility, and price holding key support zones without frantic dip buying. If the market can digest the budget and trade calmly, that's a sign big money is comfortable. What invalidates it? A rally that's narrow, a tape that sells off on good news, and a currency or bond reaction that signals stress. Because if currency stress rises, foreign flows get more cautious, and the market starts repricing risk, and that's where the real pressure starts. Now, let me be blunt about silver, because people underestimate it every cycle. Silver is not just cheaper gold. It is a hybrid, monetary metal and industrial input. It trades with emotion and with supply chain constraints. It's smaller, it's more volatile, and it gets pushed around by positioning. That's why it can outperform when the setup is right, and why it can punish you when you treat it like a stable investment. If the continuation squeeze scenario triggers, silver can gap and run in a way that makes you feel like you missed it. And that's exactly when the market tries to bait you into chasing size. Don't do it. If you're involved, have a plan, size appropriately, and respect that volatility can be used against you even if your direction is right. Because if this one level breaks, the math changes. And here's the part nobody wants to hear, but it's the reason pros survive event weeks. You don't need to be all in to be right. You need to stay solvent, stay flexible, and stay mechanical. Budget week creates asymmetric moves, but it also creates asymmetric mistakes. The mistake is not being wrong. The mistake is being wrong with size when the market is illiquid. The mistake is making a decision because you feel embarrassed you didn't predict the headline. You're not being graded on prediction. You're being graded on process. So let's bring it home with a simple, concrete checklist for the next week or two. Things you can actually watch without turning into a full-time macro desk. Watch the rupee reaction after the budget, and whether it holds for more than one session. Watch whether gold holds its breakout zone on pullbacks, and whether dips get bought quickly without panic. Watch whether silver holds the impulse base and whether volatility stays elevated in a way that signals dealers and shorts are being forced. Watch local premiums and availability. If the physical market stays sticky, that's a quiet tailwind. Watch equity breadth and skew. If the market is up, but fear is still bid, risk is not truly back. And watch the bond market reaction, because even if you don't trade bonds, the bond market trades your future cash flows for you. And finally, if you want one metric that ties all three, metals, equities, and the budget narrative, together, it's this: stability versus stress in the currency and rates complex. When currency is stable and real yields are well behaved, equities can carry the story and metals cool off. When currency is stressed or real yields get weird, metals get their insurance bid and equities get selective. That's the axis, not the headline, not the speech, the axis. If you're the kind of person who wants to stay ahead of this stuff without getting emotionally yanked around by every candle, you're already in the right mindset. Watch mechanics, not vibes. Compare notes. Stay skeptical of easy narratives, and keep your plan tighter than your opinion, because this is exactly the type of week where the market rewards discipline and punishes ego. Now watch the first reaction, then watch the second reaction. The first one is emotion. The second one is positioning. And the third one, if it comes, is the real move.